Good afternoon and welcome to part 2 of our discussion on smart GovCon business transfers, new SBA regs, and tax. I know we have a lot to get through today, so I'd like to quickly introduce you to our panel. Our first speaker, Sharon Heaton, is the founder of sbLiftOff, a national M&A advisory firm which serves owners in the government contracting space. Sharon has advised on transactions totaling more than $12 billion in deal value and focuses on bringing high-quality M&A advisory to the mid-market GovCon space. Sharon just released a second edition of her book, Liftoff: 12 Things to Know Before You Sell Your Company, published by Forbes and available on Amazon. Appointed to the Small Business Administration's Investment Capital Advisory Committee, she works nationally to increase small business access to investment capital. Next, we have Joe Cope. Joe is the founder of Cope Connelly Family Office, based in Arlington, Virginia. Joe has spent over 20 years helping entrepreneurs, many in the GovCon community, solve complex tax, estate, business, and wealth challenges. These challenges include reducing tax on M&A transactions and allocating wealth both publicly and privately. Over the next hour, we encourage you to submit questions through the Q&A option at the bottom of your screen. You can submit questions throughout the presentation, and the panel will make every effort to answer your questions. So let's get started. Sharon, I'll turn it over to you.
Thank you so much. It's a pleasure to be here with my friend Joe today. And I think that there's a lot to talk about. I'd like to start actually with the kind of big picture issues of what's going on in the GovCon market right now, which means that we have to talk about Doge. And the question is, what has happened? What is happening with Doge? It's pretty clear that there was a bit of a shock and awe element in January, February, when there was so much activity, so many executive orders. The executive orders continue, but I think that they're not at the same velocity that they had been
Right.
previously. Joe, what are your clients hearing or seeing about Doge at this point?
I think it's quieted down greatly. I think I agree with you, Sharon, that it really was a shock and awe campaign, that they were coming in, they came in heavy with cuts. It seems to be, I don't know if you saw that interview with Jesse Waters and the roundtable, and, these got some insight as to who's in there and what their tenor is. I thought I listened for that. And it really, to me, was focusing a lot of the fraud, the abuse, the things that were kind of the low hanging fruit. I did not hear anything of operations or actually the word efficiency. I didn't hear a lot of that. And so I think, our clients are kind of through that first iteration, and maybe we're waiting a little bit on pins and needles, but we're not seeing as much now in terms of cuts. I have not heard that. I have not heard the same amount of stress that we had, 2 months ago. How about you? What's been your pulse?
Every business owner I speak with says, well, that's not true. The business owners who have not yet been hit by Doge say, I've not been hit yet.
Yeah.
Because the reality is, it's a little bit like standing out in a field and being struck by lightning. It's not quite predictable. My gosh, if you were in USAID, or if you were working on a DEI contract or a series of DEI contracts, we know that's low-hanging fruit. I'm not going to say it's waste, fraud, and abuse, but that's how the administration sees it. So be it.
Yep.
It's unclear exactly where the waste, fraud, and abuse is. Nobody in their right mind is going to say that the federal government is one of the most efficient organizations in the world. It's not. And could it be made more efficient? Absolutely, it can. I was just on a panel this morning with somebody from the Heritage Foundation who basically said what's going on right now is not unprecedented, in that the Reagan administration tried to do something similar. And then, interestingly enough, the Bill Clinton administration, in their reinventing government, they basically cut the government workforce by 300,000 people and did it without any litigation or claims, etc. It does feel like the haphazard element of it might have changed at this point, but
Yep.
I don't think that we're done. And what people are focusing on is whether or not their contracts are essential. What is the essentiality of what it is they're doing for the government? And that's probably the biggest protection that they have.
Yep.
We have advised clients, and we've certainly seen clients do this, write up a 2-paragraph description of the contract. Why is it important? What does it do? How does it save the government money? How is it mission oriented? And I think that there's been enough of that messaging to GovCon owners that people are walking around with that for each one of the contracts that they have. What are
Yep.
you seeing?
Yep, same thing. A little bit of why do you work here? What do you think? What do you do here? In a tech quote office space. But I think in many ways, the critical mission and the things like cyber and infrastructure and IT support. These are all critical things to run the government. So I have not heard a lot of Doge getting into that sphere yet. And I do say yet. I think that's probably they're going to be there for a while. I think a lot of our clients that I talk to, they're doing really critical, very interesting things, and they're adding a lot of value to the U.S. taxpayer. I really believe that, and so I think there's an element of that I think has staying power.
I saw a statistic recently that 1,800 government contractors have been hit by some type of Doge impact. 1,800 is a large number.
Yep.
But when you think about the fact that there's at least 50,000 GovCon companies, we're talking about approximately 4%.
Yep.
Now, that doesn't mean that it's not going to, get further and more, but it does create uncertainty in the market. And uncertainty in the market, I found in the first quarter, tended to cause people to freeze in their tracks. It's
Yep.
like, I don't know if I should move left. I don't know if I should move right. So I'm just going to stay still, except for those companies that actually had a Doge impact and had to take some pretty clear steps. How was the first quarter of the market in the financial sector before we get to Liberation Day? Liberation Day, that's the second quarter, it's April 2nd, et cetera. But tell me about the first quarter.
Yeah, it was a volatile time in the markets to begin with. We saw, a rise in asset prices in January, a little run up, and then kind of post-election or post-inauguration, we saw kind of the Trump trade pare back, and it's been doing that since Liberation Day. But certainly the Trump trade went off. We saw a large drawdown in mega caps, kind of the Magnificent Seven that you're familiar with. They've since rallied, I think, since Liberation Day. But it's been a very, very volatile year. More volatile, probably the most volatile year I've seen since 2008. There's a 2022 drawdown, but that was really interest rate related. This is not unprecedented, but we haven't seen this in a long time. And I would say investors have been uncomfortable, for a good period of time.
I think that makes this one unique, however, is that this is the direct result of government policy. The 2008 financial crunch caused by lots of different factors, certainly the changes in the economy around 2000, 2001. But this is a direct impact as a result of government policy. Is that a fair assessment?
I think ish. And the reason I say ish is that the global financial system, globalism, has created a highly financialized structure in general, which is the artificial suppression of interest rates, forward guidance by the Fed, which had never been, by the way. Prior to Bernanke, there were all these. There were memes before they were memes. Like, how thick was Alan Greenspan's briefcase walking into the meeting? Right? If it was thicker, if his pad was thicker, it was mean that he was going to raise rates. And so there was all this idea, and then the Fed came out to try to give certainty. But the certainty aspect of the Fed and these policies has led to a little bit of drunkenness on excess liquidity. What we saw in April in the sell-off was actually a form of something called the basis trade, where individuals or institutions in Europe specifically had bought our treasury bonds, levered them 40 times, taken that capital and reinvested it either in distressed bonds elsewhere or really into US equities. And as soon as there's a fraction or any type of issue with the dollar, that trade has to get unwound. So they're selling bonds to get cash, to reconvert, and then they're actually selling all their equities. They're getting out of their equities because they're starting to see that. So there's this stacking of leverage that's across the global system that has been a result of all these global policies. And I think that's of the greatest concern to me, is I look at this kind of globalistic, financialized system that has a ton of leverage, ton of stress in it. I think, to me, those are fissures that become bigger cracks when something like a volatile person comes in and starts shaking things up. It's taking the fissures and kind of making them cracks, but the cracks are already there.
Very fair point. Very fair point. It feels to me like the holy grail is the continuation of the dollar as the global currency.
We have to have that.
We absolutely have to have that.
Have to have that.
In light of what's going on with foreign affairs, the president's I would say tweeting, but that shows me to be old. There, his social
It is
social
now
truth.
posting on X. Sure.
Exactly. Where do you think we are as the dollar as the reserve currency?
We have to. I think the administration is keenly aware that we have to keep that. And so I think the attempt to pay down our debt is telling the world that we are keenly aware that there's an issue. I think it's a good thing that we are taking a serious, hard look at how we spend money. With that said, if we could cut $1 trillion just out of Doge, that would be a miracle. But there's another 6 trillion that are in the the set asides and entitlements that they're going to need to get into, mainly because our debt is increasing by $1 trillion every 90 days. I mean, that's why they're pushing so hard to try to reduce rates, is because they have 9 trillion of debt rolling over the next 6 months, and they need to refinance it at a lower rate. So there's a lot of pressure, I think, administratively to create more solid footing and foundation, of the economy here to kind of keep things stable. Now, maybe that's not working very well when you're ripping tariffs here or there. I don't know how that all fits in with that plan, but there's a serious issue here that we need to deal with some big things. And I guess I'll wrap that in, Sharon, because that's maybe a very high level point. Like, if what we're to say, there's like capital that you're allocating as individual investors. That's certainly something to talk about. But I think as business, like, there's only so much that they can go after in terms of efficiency from these types of contracts. There's stuff that we need. We're going to need to do it. I really believe this is a weathering the storm here. And invariably, if things hit the fan, the government will spend money. So I'm of the mindset that may be the way that they're kind of cutting now, but they're going to have to deal with some other stuff to try to get our currency stable. And I think for our GovCon clients, I really see them needing to actually allocate a little bit more capital. I don't think it's going to be this, they're going to cut what they think they can, but they're going to pour more money back into the critical infrastructure.
It's a very, very good point, and we'll turn off of this kind of global stuff in just a moment. But if we were to eliminate the entire civilian government, everything from the
Everything.
FAA to the SEC to the entire civilian government, you still have $1 trillion deficit this year.
Yeah.
If you were to eliminate the entire civilian government and the entire military budget, you about break even.
Yep.
We're not going to be able to do something big until we start dealing with the entitlements issues, and whether that's taxes or cutting back benefits, I have no idea.
Yeah.
Thank God that's not my job.
Thank God.
But I can know that you cannot do Doge focusing on whether it's the civilian or defense and get to that balanced budget.
Yep.
It doesn't mean that we shouldn't take action against wasteful spending. All of us are taxpayers, I hope, and we should in fact care a lot about how our dollars are spent.
Yeah.
But it's a little bit like, changing the wrapping paper without getting to what's actually in the box.
Yeah. So how have you seen this? I mean, I agree with that. We have to do something. We're doing something, good or bad, but we're doing something. So then I guess my question for you is, how have you seen this now? I mean, we've kind of been this globalistic. We're in a little bit of a crisis time. We're very uncertain. We keep hearing the word uncertain, which uncertain is bad. It's another word for things are bad, right? I hear all these CEOs in their quarterly calls saying it's a lot of uncertainty, so they're not allocating capital. But so how have you seen that play into the M&A markets this first quarter, and I guess this past month?
Very interesting. First, let me start off by saying there's not one M&A market. The M&A market has a lot of different subsectors. So I'm going to focus on the GovCon M&A market. And even there are subsectors. If you're talking about a $1 billion full and open company, that's very different than a $100 million company, maybe that's full and open, which is also dramatically different than a $20 to $40 million company that maybe has set asides, maybe they're just beginning to get into full and open. The area that sbLiftOff plays in is companies that have 10 million to 100 million in revenue. And that means we're playing in what's referred to as the lower mid-market. I'm just a kid from Long Island. I think $100 million is a lot of money, but that's okay. That's the lower mid-market. So what we're seeing is that there are people who are already in processes or getting ready to go are moving forward. And people who are working about, founders who've worked on their company for a number of years and want to retire, those processes are going forward. No surprise there. What's shocking to me is how many buyers there are. You would figure that in this time of uncertainty, the buyers would be going pens down, deer in the headlights, we're not doing anything. And in fact, that's not what we're seeing. And when we're asking people nicely, what are you doing? They come back and say, GovCon's not going away. The
Yeah.
federal government, in fact, by downsizing the people, need to rely more on government contractors.
Yeah.
So we find that buyers are extremely interested in finding companies that have customer intimacy,
Yeah.
some capacity, some type of, not solely butts and seats, but rather bringing some specialization to the government that may not make sense for the government to bring inside to the government itself.
Yep.
And customer intimacy is a challenging one right now, because, hey, listen, there's been a fork in the road. And very often, some of the people that government contractors worked with in the past are leaving the government. So the
Yeah.
question becomes, do you still have the intimacy at those agencies? And I'm seeing really smart government contracting owners focusing on rebuilding those relationships with the people who are there.
Yeah.
So that
Yeah.
customer intimacy, the capability, the employee base, people, of course, who have clearances, things are going forward. Sometimes buyers are looking for what I refer to as a flying purple unicorn. They want a
Sure.
company that's 15 million in revenue, that's all full and open, that's 100% prime with 20% margins. It's like, well, that's fine, and I would like to be 6 feet tall, but you're not going to find that. So I think that there's a little bit of realism. And truth is, deals are going to be structured differently.
I agree with you.
Where
Yeah.
the amount of cash at close used to be 80, 90%. I think that that cash at close is going down and there'll be more structuring on deals. Joe, what are you seeing?
Yeah, and that's actually was my exact point. So thanks for saying that. Is the deal structure, the appetite is there, and I do think that there has been um, kind of a narrowing of difference between buyers and sellers valuations, where a seller used to say, I'm worth this much, and the buyer was like, there's no way. And now I think buyers have, or sellers, excuse me, have a little bit more understanding of the risk that's under their feet, and that de-risking in some way may require some concessions, right? It may be more seller financing, it may be an earnout, it may be something else, but there's enough risk, I think, to compel sellers now to take those terms, whereas before they just said, well, we'll wait it out. And I think buyers, to their credit, have not taken advantage of that. I still think they were always trying to look for but I think now the terms are favorable enough that they're willing to take the risk, even though there's risk under their feet too. So to me, it's become a little bit more less like in a disparate kind of poles where people are, and it's a little bit, they've come closer together. And I think that's probably a healthier place. I think more deals will get done as a result of that. The good deals will get done, right? Whereas maybe before there were kind of crazy valuations or things like that. Now I think we're kind of probably coming closer to a little bit more of a stasis number.
It's a really good observation. And there's two ways to deal with this level of uncertainty. One is you lower valuations. If a set aside company
Yeah.
would go for between 3 and 6, well, maybe now it's 3 to 5,
Yep.
and that's certainly possible. The other is to, whether it's an addition to a valuation decrease or otherwise, the issue really is Doge. The issue is, are you standing in a field and getting struck by lightning? And every business owner can say, as a seller, I haven't been hit by Doge. I will not get hit by Doge. And every buyer is going to say, yeah, but what if? So one of the things that we're seeing is, as you said, more contingency in terms of things like seller financing. But the
Mm-hmm.
seller financing itself is usually non-contingent. The buyer owes that money to the seller, but we're seeing a little bit of a clawback if there's a Doge impact, if is backlog that was delivered at closing that goes away.
Yeah.
So it's important to distinguish this
Yep.
because, if it goes away because of Doge, all right, that was a seller's
Sure.
risk that they continue to hold on to. If it's a buyer who screws up a contract and doesn't return phone calls or does a bad job,
Sure.
that's on the buyer, not on the seller. And people are agreeing to that kind of construct.
Yeah, I think that's right, and I think there's some reasonability here, and the risks under sellers' feet has caused that. So I think it's okay. I
think
think
it's
that's
okay
an
too.
okay then. Yeah, I think it's a reasonable dynamic.
So let's talk a little bit about preparing yourself and your family for a business sale.
Yep.
If you asked me 2 or 3 months ago, I'd say, is it worth getting ready? My answer would have been yes,
Yeah.
because this is something that takes years to get done. It's not something that you can say, oh, I'm going to start the process in November of 2025. I'll get started in September.
Yeah.
One of the things that we as an M&A advisor say that in order to go to market, two things need to be ready. One is the company, and let's talk about that. But
Yeah.
two is the business owner. And Joe, I think that's really where your expertise is. Talk to me about what a business owner should be doing to prepare for an exit in a year from now, 2 years from now, 3 years from now.
It's a great question. Yeah, I think we need to talk about both on this call because I think they're both important, right? Getting a business healthy and getting your personal balance sheet and situation healthy. So yeah, I would say we pride ourselves in our exit planning, our tax planning, our estate planning. I'm certainly not a CPA or an attorney. But I do know a lot about those things. We allocate a lot of capital pre and post transaction for families. But the way I'd say it is, look, once you have an LOI in hand, and the LOI says your company is worth $25 million. I can't tell the IRS that your company is not worth potentially worth $25 million. You just can't do it. But prior to having an LOI in your hand, there are certain types of trust planning, estate planning that you can do that involve valuations of companies and significant discounts. And that's because you don't have an LOI in hand, and we can apply certain discounts called lack of marketability, minority control discounts. Usually it's like between 30 and 40%. You can get discounts and do some significant estate planning work that will help shield your family from future taxes and then also potentially some taxes on that actual transaction. And that's how I would categorize tax. It's tax that your family pays when you die. And then there's tax that's paid along the way while you're actually running your company, income tax, but then there's also capital gains taxes that you will pay when you sell. And the preparation that we need to do that planning, I would love at least 6 months. I would love them to be in different tax years. We can do them right up to transaction. I got a deal right now that we're going to do with an LOI in hand. It's okay. We can just do some of this work, but I would love a little bit of lead time. That's helpful.
It's interesting. I generally tell people, please do it in a different calendar year.
Yeah.
If you're going to decide to move to Florida, don't move to Florida in the same year that you're trying to sell.
You can. I will say we had a client a couple of years ago move in June, relocated. Now, when you do this, you have to go get a dentist. You have to relocate your kids. You got to get a lease. You have to have your cell phone. They'll track that. Especially if you're in Maryland, they're a big Nexus state. They're going to nail you. DC, maybe Virginia, a little less so, but you can do it. And we can actually help you document the whole process. And it's kind of the easiest thing to do in some ways, but it's also, if you have an 8-year-old and a 10-year-old in school, the chances of you doing that are very low. So that's a tough, that's a tough thing to do. Now there's some other ways to kind of get around this stuff, but I do love the 6 months and different calendar years. Sharon specifically is for trust planning. If you take your shares of your company, you place them in a trust, you're going to file a gift tax return, let's say in 2025. And let's say that you tell the IRS that your company is worth, we have valuations that's worth 10 million, but then you sell it for 20. It's better for that 20 million to be recognized in 2026's taxes, not the same year that you tell the IRS it's worth 10. So there's an advantage to having a little bit of a January 1st, December 31st, date, if we can help it. I would not turn down money just for that fact. I think you would probably agree with that. So I can get into some more of those, but I'd love to put the question back to you. What do you think on the business side? What are the kind of key things that you're telling your owners as you sit down with the company, you evaluate where they are? What are the things that they need to get in order before bringing their company to market?
Incredibly good question. Every company has strengths, but every company has challenges as well. And the business owner needs to understand what those challenges are, which ones are fixable and which ones are just inherent in the company. If you're an 80% subcontract company, you're not going to change that in the next year. You just have to recognize that there's going to be an impact on that. So what we're telling people is, hey, listen, customer intimacy is incredibly important. Backlog is really important. Interestingly enough, there's a change at this point where multiple award contracts might in fact be less valuable than single award contracts based upon an SBA rule that came out at the very end of 24 and
Yeah.
became effective in January of this year. So for years, we've been advising clients, go get as many IDIQs and BICs and other kind of vehicles that you can. The large vehicles, whether it's Oasis Plus or Polaris, et cetera. Now, companies with single award contracts actually might have a slight competitive advantage because the SBA rule will not have any impact on those. So let me take a step back and talk a little bit about that SBA rule, because I think that going into 2025,
Yeah.
most of us thought that that SBA rule was going to turbocharge M&A, because it basically said, if you are a set-aside company and you are acquired by a buyer that does not meet your set-aside designations, that buyer will not be able to exercise the contracts that you have going forward. And the language was somewhat loose, and it was very unclear what the interpretation was. Over time, it's become clear that the SBA is saying, no, if you have a task order, you're going to be able to serve out the task order, not only the period of performance that you're currently in, but rather the full 3 or 5 year term of that task order. That changes things a lot. That means that anything that you've already won is great. It does, however, impact the companies that might have a very significant vehicle that in the past, when they sold, if they had set asides, the buyer, regardless, could in fact get more task orders under that vehicle.
Yeah.
Under the new rule, you really can't. So it really was the unusual company that had contracts or vehicles that they could get more work under that was so desirable that buyers were coming in to pay them for. That I think will change. Certainly it's changing in 25 and that door will close in 26. But the task orders that you have are valid, which means that the backlog is stable. And that makes a huge difference. Interesting. We thought that the SBA rule would really accelerate M&A, and then we have the Doge impact, which really slows down M&A.
That's right.
So you've got lots of things going on in the market simultaneously.
Yeah, I really thought we were going to be at a 9 or 10 when the SBA rule was starting to be interpreted. Obviously, that's come down. Maybe Doge has increased it now, but yeah, that rule I thought was when it first came out was a kind of a game changer, that there would be a ton of small business activity this year. I still think there is, and there's still reason to transact, but maybe it's not, everything's on fire. We need to get out the door right now before January 16th, 17th of 2026.
It is far better to not do a fire sale. You
Yeah.
shouldn't be doing a fire sale because your company needs a fire sale. You shouldn't do a fire sale if you personally need it, if you can avoid it. And certainly with these rules, doing a fire sale is not the best way of maximizing your value.
Yeah.
So as we're talking about value, maximizing the value, there's one thing that I'd like to discuss, which is kind of a little unique to the GovCon sector, which is for M&A, most privately held companies are sold as an asset deal.
Yep.
That is, the buyer comes in and buys all the assets, including the name and the reputation and the employees and all the rest of that. And they do that for a variety of reasons, one of which is a liability shield, but second is as that there's a stepped up tax basis for the buyer. GovCon is different, where GovCon companies are generally done as stock deals. Now, those stock deals then are done, but the IRS being what it is, there is a provision that says, oh, did you do a stock deal? You can still treat it as an asset deal. And that basically increases the taxes of the seller and decreases it of the buyer. But in so doing so, the buyer's benefit is so great that generally they will pay the seller the amount of taxes that they are now paying that they otherwise wouldn't have had to, and even grossing up that difference. Are you seeing any changes in either asset sales or stock sales in either the GovCon or the non-GovCon sector?
I think that's a great question. And we have seen both deals. Some people prefer the stock deals. I would say buyers in general want to do an F reorg, that if you are an S Corp, they're going to expect you to do something called an F reorg, which is a reorganization to effectively a partnership or an LLC. And that is so that the buyer can depreciate some of the purchase price. They want that tax benefits. Now, I think a good skilled M&A advisor like yourself, Sharon, if that is the request, then the seller would receive less money. So there's a gross up, as you said, there's a gross up to kind of meet that tax benefit, or at least maybe split half the difference or something like that. So you kind of get ahead of that. Usually I see that in the negotiations. Now, if you can avoid the FRE org, if you can sell as an S Corp, there is a significant advantage in that your long-term capital gains tax treatment of an FRE org of a partnership will be 20% plus your net income tax, which is the extra surplus Medicare tax, which is 3.8%. So your federal tax would be 23.8. However, S Corp stock, when sold, is only subject to the 20% tax. It's not subject to 3.8. So in negotiations, if you're actually getting kind of forced into the FRE org, it's not just the tax benefits you're going to lose that they're going to gain from depreciation. It's you're actually now having to pay an extra 3.8%. So there is some math that needs to go into these negotiations, or you simply ascertain we're not doing that for you, we're gonna stick as it's an all stock transaction, right? Maybe we reduce our price by a little bit and we split that tax difference. But there's just a couple nuances for the clients I have seen go as S corps. It's nice. It's only 20%, not that extra 3.8.
Very interesting. So if a buyer can actually acquire the S company directly,
yep.
There's a slight tax benefit to the seller.
To the seller, yeah. And it's 3.8%. It gets a big number, $10 million transaction, 380 grand. Like these numbers add up. On big numbers, the tax numbers are even bigger. So
absolutely. In fact, we talk to our sellers all the time and say, hey, listen, the purchase price is fantastic. Please understand that you're not putting the purchase price into your pocket. By far, your biggest cost is going to be taxes.
Yeah.
But there's also going to be lawyers' fees and accounting fees and M&A advisory fees and all the rest of that. So that purchase price is a nice headline number, but the real question is how much you're going to be able to keep in your pocket. So Joe, let's talk about how people can maximize the amount that they keep in their pocket. And again, you talked a little bit about trust and estates. Let's put that aside for a second. But if somebody's getting ready to sell their company, what can they do to try and minimize their tax burden in that transaction?
Yeah, let me actually just share a quick slide here. I'll pull this up because there is a couple different capital gains tax reductions. There's two different sides of capital gains taxes. Number one is the federal side, and number two are the state capital gains taxes. The state capital gains taxes are entirely based on where your residency is. So I'd say in order to avoid capital gains taxes, the number one move is to move to Florida, Texas, Tennessee, Nevada, anywhere that if you can go there and you can be there for 182 days consistently and actually move there, you will avoid the capital gains tax treatment on your transaction. As the numbers go up in your transaction, the more valuable that becomes. That just may not be possible for a lot of folks. Again, I kind of mentioned earlier, parents who have young children in school, is very difficult to pick up. Now, for a couple $1 million on a big enough transaction, you might say we can quantify that. Maybe it's worth it. I had a client now who has a family house in Florida. They've been thinking about moving to Florida, so I think it's actually a potential move. But there also exists, I think this is what's fairly interesting. There are some other tax favored states that have state income taxes that if you live in them, they play nice with some other tax-free jurisdictions. So I listed them here. So if you're a business owner who lives in these states, North Carolina, South Carolina, Georgia, Colorado, Utah, New Jersey, Indiana, Kentucky, Montana, Mississippi, California, there may be one or two others I missed. If you live in those states, or you have a second home where you could officially reside in those states, there's a way that we can get some trusts established that if the shares of your companies are in these are in a trust, usually in a different jurisdiction, Delaware, Wyoming, South Dakota, Nevada, Alaska, Florida, you'll notice these are all tax-free states. They're over here. If we can get your shares into a trust in one of these states and you live in these states listed here, then we can avoid nearly all the state capital gains taxes that you would pay if you lived in those states.
Let me restate that to make sure I'm understanding you correctly.
Sure.
On the number one favorable jurisdictions, I guess that's D, you're listing 1, 2, 3, 4, 5, 6. Six states. And if you're there, there's no capital gains on the sale of your company.
Correct.
Here, what you're saying is if you move over to avoiding state capital gains taxes and we're looking at B, 2 Roman two,
Yep.
then even if you don't live in the states that we just mentioned,
Correct.
if you live in these, you can still create a trust under the states that have no state capital gains tax.
Correct. So to give you an example, I have a client right now that's in Pennsylvania. He happens to be building a house in New Jersey. Smart man. You're going from a 5% tax state to a 10% tax state. It seems like a bad idea. However, if by becoming a resident of New Jersey, we can get a trust that is domiciled in Wyoming, South Dakota, and Nevada. We can place the shares of his company into those trusts. He retains full control over everything. When he goes to sell, he'll pay 0 New Jersey capital gains tax, which by the way is 10%. So it's a pretty significant company, $100 million transaction. He's going to save $10 million just by moving across the border, because Pennsylvania is not a state that plays nice with these 5 states over here. Who else doesn't play nice? Anywhere where we live, unfortunately. DC, Maryland, Virginia, West Virginia, Pennsylvania, they don't play nice. We can't do this type of planning for those particular states. But if you can be in North Carolina, you can be New Jersey, South Carolina, Georgia, Colorado's quite nice. A lot of people like moving to Colorado. They can live there for a period of time. They have a second home where they could conceivably have a residence for live there for at least 182 days. There are some ways to do some sophisticated tax planning to reduce your tax burden.
So let's talk about that for a moment. Obviously, you've got these states. Now, I've heard many times about the Delaware Trust. I've heard about Nevada trusts as well.
Yep. Sure.
How does the Delaware Trust or the Nevada Trust play into any of this?
Yeah, so this is really good. There's some other federal tax. I'll get this in a minute, but thank you for asking that question. So all trust planning is not the same. All states are not the same. And you are eligible to have a trust in pretty much any state you want, as long as you have some reason to do so. And the reason that you might do so to satisfy the CITES requirements of having a trust, let's say in South Dakota, is that you want a trustee in South Dakota. And so you hire a trust company, and the trust company might cost you $2,500 a year. And so now you get to have a trust with the rules and the laws of South Dakota, which happen to be a lot more favorable and a lot more flexible than the state of Virginia, Maryland, or DC, where the majority of our listeners usually live. But anyway, for a lot of other states, these kind of 5 really good jurisdictions. And the biggest feature that is by far and away the most valuable trust planning feature that I hear that allows people to take action is pertains to irrevocable trust. So most of us prayerfully would have all our basic documents set up, right? Like this is like a living will, how long do I want to be on life support, financial powers of attorney, things like this, like a basic revocable trust. None of this does any tax planning. It just makes it easier on the people, if and when we die. Irrevocable planning is placing assets into a trust that we think are going to grow significantly over time and get all of our money outside of this estate tax regime, which is basically the amount of money that you're taxed after you die. And if you have a lot of money, they're going to tax you at 40% if you've done none of this planning. So there exist these trusts which are irrevocable. It's a very binding word. And let's say you open up an irrevocable trust. We establish one in Virginia. You make a gift. Your husband, you make a gift of your assets. The stock of your company goes into a trust for the benefit of your wife and your kids. And you want to do this. You want to avoid the estate tax. All good. But here's the problem: if your wife predeceases you, all the value of those shares is now transferred directly to your children. You can never get it back. Now, while she's alive, you can access all your funds through there. But there's a very permanent nature about doing this planning and doing it in these jurisdictions and that we live. When we write these types of trusts in Delaware, Wyoming, South Dakota, Nevada, Alaska, Florida's trying to catch up. They are what are called self-settled jurisdictions. And what that simply means is that the grantor or the person who puts the stuff in the trust can add themselves back as a beneficiary to their own trust in the future. A revocable trust, I call it, becomes revocable, but you can get access to your stuff.
So wait a minute, you can create an irrevocable trust and put yourself as one of the beneficiaries of that trust.
Correct.
So while it is now outside your personal domain,
correct,
you are and you'd have a third-party trustee, I'd imagine.
Yeah, and on another call we could go through all the trustees and the mechanics of it, but Yes.
Let's not.
Yeah, let's not now. It's probably bore everyone to death. I find it fascinating naturally, but but yeah, this is, you're walking down the middle of IRS Boulevard. You walk down the middle of all these states Boulevard. We're doing everything to the laws and the rules, but they're very, very technical trusts that are drafted with very technical language. And you don't make it explicit, but you put it in there that you can have access. And what I've found is that for most owners who need this planning, it's the way that we can do it without feeling like, wow, I'm making a decision that I could really regret.
Very interesting. Because, hey, listen, in the scenario you gave, the wife might die, the children might get it, but there also could be a divorce.
There could be, yeah.
And that could have a significant impact. To what extent have these rules been litigated? That is, have any of the states challenged them? I mean, the Delaware Trust has been around for forever,
Yeah.
but some of the stuff's pretty new, particularly the idea of an irrevocable trust with the grantor also being a beneficiary. Has that been litigated and proven out?
It's a state matter for each one of these states, and they've all upheld their own rules. So they would be kind of, in some way, self-defeating if they said, "Hey, we hold ourselves out to be these favorable states, and now we're going to beat up our people who." It's a little bit what like kind of Delaware did to Tesla. Like, not a good move, right? Like, you don't shoot the people who are paying your bills, and So there's problems there, but that was a rare thing. Delaware's been the best, or been one of the best for the longest. My hesitation a little bit in like the Wyomings and South Dakotas, they're kind of newer to the game. They haven't been doing it as long. They saw the opportunity to do it to kind of generate business for their state. So they're a little bit newer. There might be some judges there that may not be as favorable. Delaware, Nevada, even Alaska have been doing it a little bit longer. And so I maybe out of that list, I gravitate toward those states. Though I would say South Dakota probably has the best rules out of everyone there.
Okay. I'd like to turn to the questions. We've gotten a couple at this point. Who are the primary buyers in GovCon? PE, large primes, mid-market? Yes, but there's others as well. Let me go back to what I said initially is there's lots of different parts of the GovCon market. So if you are selling a set-aside company, you're $25 million in revenue, but 100% of your stuff is small business, SDV, OSB, women-owned, whatever it might be, highly unlikely you're going to sell to a PE. PE is primarily interested in buying full and open work. Large primes, again, depends upon the meaning of the word large. If you're talking about a Leidos or somebody who's a multi-billion-dollar company, they're not going to be interested in buying a company that's, under $50 million. The transaction costs for them are just too great. So I start off by saying, who are the primary buyers? It depends upon what part of the market that you're in and what kind of company that you're bringing to market. In addition to PE, large primes, and mid-market, there are strategics as well who might not be in mid-market. They might be in small business. There's also a fairly significant group of searchers, and searchers are a relatively new phenomenon, and they range the gamut. Sometimes a searcher could be somebody who owned a company previously, grew it, sold it, waited out their non-compete, and wanted to get back into the game. Sometimes a searcher is a 26-year-old who says, I want to own a company and I have 45 cents to my name. Let me see what I can do. Well, there was a time where with virtually no capital, you could acquire a company, but those days are pretty much gone. So you really need to have a more specific question on what part of the market, what does the selling company look like to figure out who are the primary buyers for that. And that's part of what Joe and I help clients to understand. Joe, anything you want to add to that?
No, I think it's great. I mean, to me, it's so dependent on who you are as a company, who's going to buy you. It is like what your makeup is, that is going to be the thing that drives who your buyer is. Plenty of capital out there, plenty of interest in GovCon still. I mean, I think you probably saw it. We saw the massive proliferation of PE exposure to government contracting in the probably the 21 to the 24 run up. Doge has made it a little bit more interesting, but they were coming because they're cash flowing businesses and they had been very resilient. We didn't know the executive order could cancel contracts, but so I think it's news to all of us. But I think the financial buyers came in heavy. They're still here. They're not going away. People are getting more educated, I think is good. I mean, a friend, client of mine is the CEO of a company, a family office backed company that they didn't know what a set aside contract was after they bought the company.
Wow. Wow.
So the lack of experience, they just kind of looked at the fundamentals, and again, kind of these funny stories. The CEO is getting a call from the family member saying, "What do you mean you can't like talk to the contracting officer? Why don't you just walk in his office and talk to him?" And you're like, "What are you talking?" Like, they don't know the business. So I think there's been a very good education of financial buyers, but they're not leaving either; they're staying. So they're here.
A year or two ago, financial buyers were like flooding into the GovCon market. And truth is, at sbLiftOff, we were pretty dubious of those folks because many of them had no idea what was going on in the government contracting market.
Yeah,
I think that there's still a lot of PE interested in GovCon, but they tend to be more sophisticated now. If you're a seller and you're trying to sell your GovCon company, trying to find a buyer that knows GovCon, I think is pretty important. There's so many ambiguities when you sell a company. What's
yeah,
going on with the company? What's going on with the buyer, et cetera. Trying to bring somebody up to speed on GovCon at the same
yeah,
time is an incredibly heavy lift.
yeah, yeah. Agreed.
Let me go to another question. What acquisition multiples do you see for businesses that are 100% set aside contractors? Well, I am a recovering lawyer, so I have to give you this answer. It depends. It depends upon what kind of set aside subcontractor they have. One value that you almost always have is some type of discounted cash flow of the backlog that you have. We had one company that was set aside and a subcontractor, and they had over $200 million of backlog. Now, that is a huge amount, and we could figure out what their margins were and do a discounted cash flow and say that's the value of the company with some risk premium put in there. In terms of multiples, the question becomes what set aside do you have and why are you a subcontractor? Are you a subcontractor who's doing just kind of ordinary pulling a wire through the wall for IT, or are you doing some very high end specialized work? If you're doing kind of ordinary course of business that could easily be replaced, then it's going to go to what's the relationship between you and the prime. If it's a prime that could cut you because they want to, then you're going to have pretty minimal value. It might be the discounted cash flow of your backlog. Maybe it would be one or two times your EBITDA. But basically, you need to understand that if you're looking at your EBITDA and you're saying two times, what that means is that if the company doesn't grow, the buyer is giving you the next 2 years of profit. And they don't want to give you 5 years, 7 years, because there's uncertainty as to what's going to happen. So one of the things that I think is happening is that subcontractors are taking a little bit more of a hit on valuations unless they have something that is a unique capacity, security clearances, a very tight relationship with the prime. They're doing something that the prime couldn't, particularly in places like the IC, where the IC tends to give fairly large contracts, and then there's subcontractors that come in under that. And it depends upon what that is doing. But we would say, to answer the question, anywhere between 2 and 5 is that EBITDA multiple. And it's definitely a challenging market to selling a set aside subcontractor market.
Yeah, I would probably add too. I think you touched on the intelligence community is really. I don't know if you've seen this, Sharon, but at least in the past couple of years, we've seen pretty high valuations in the IC, mainly because those agencies won't. If you sell, it doesn't really matter if it's small business set aside. If you're doing work, they keep you, and it's kind of a known, unwritten known thing where if you're doing good work, it doesn't really matter who owns you. So they're going to keep the contract. So I've seen healthier multiples in the IC community to a degree. Maybe it's not all the time.
I'll go one step further, which is,
Okay.
as a general rule, the IC doesn't care about set asides.
Yeah, they don't.
Doesn't matter. I've had veterans turn to me and say, "Oh my God, the agency that I work for doesn't care." I was like, "No, they really don't care. What they're focused on is, can you do the job? Can you do it efficiently? Can we rely
Yeah.
upon you?"
Yeah.
So it is absolutely true that multiples in the IC market are higher than they are even in the DoD market.
Yeah.
Okay, so with one question here, what kind of multiples are you seeing? Is the value based upon top line or bottom line? Um, Again, it depends. Most of the time, it's based on bottom line. So you get to a net income number, you convert that net income into EBITDA, and then you do an adjusted EBITDA to figure out what would be the expenses or what is the amount of cash flow that the buyer would actually get. So that's kind of the bottom line. The top line is a revenue number. I've had a number of companies turn to me recently and say, I want to sell based upon a multiple of revenue. It's like, well, I
Sure.
completely understand why, but nobody's going to buy you that way. The only companies that really get valued based upon the top line typically are software companies, very rapidly growing companies. There's something called the rule of 40, where you're looking at what is the growth rate of the company and you're looking at what is the margin of the company. And if you hit those things get combined and you get to 40, that's really desirable. And you can probably do it on a top line. But other than that, and in most GovCon circumstances, it's based on bottom line. And that can be, we had a $100 million company that was a VAR, but they only had about 3% margins. Okay, that's 3 million, but it's $100 million revenue. And they kept on pounding the table and saying, we have 100 million in revenue. And I say, yes, but the buyer is going to be interested in the profitability of that company. And that is where you've got the 3 million in revenue. Joe, how do
Maybe there might be a Nick's question. So if you look at it, Nick just pop one in there, kind of talking about subcontractors. Maybe that's a reseller kind of thought or in that range. Is that similar to what you were saying in the VAR or scenario?
The VAR basically has particularly low margins.
Yeah.
Most set-aside companies, most GovCon companies generally have somewhere between a low of 7 or 8%. 10% is kind of the norm. I see certainly companies that get to 15% and higher, depending upon how they're run. So the valuation multiples for set-aside businesses that now this is a little bit different because they have, I'm assuming it's a prime contract, and what they have is subcontractors under them. And the reality is, to a buyer, it matters more about how profitable the company is.
Yeah, that's kind of what I was thinking. Say that's the VR conversations, the profitability of this. Yeah.
Exactly, the profitability. Hey, listen, if you have a company that's doing $30 million of revenue, but you've got a very small number of people, and really what you're doing is outsourcing a lot of the work, the real issue is on that $30 million of revenue, do you have a 10% margin? Or do you have a 5% margin or a 15% margin? That's where the real issue is going to be. Some prime companies really want to self-perform as much of the work as possible. That's kind of a preference. And it ultimately comes to, is it increasing the profitability of the company or not? Joe, your thoughts?
Yeah, I that's kind of what I was going in the VAR is the profitability. If you're using subs and you're only doing 10% of the work yourself or your direct, kind of direct employees, and then everything else is sub, the margins on the sub is going to be less. So that was more, I think, the question. Nick, if you have a follow-up, feel free to chime in. But it's always, I think it has to go down to, there's a disconnect between, or not the disconnect, but the relationship between the revenue and the profit. They care about the profitability. Now there's an efficiency, there's add backs, your salary, and maybe there's a significant amount of add backs you can add back to get from 3 to 4, 4 to 5, or more. Maybe there's some certain efficiencies that a buyer might see and say, hey, I really like this. But it really is based on how profitable your company is. That's what I'd really focus on, is drilling down on that number is what a buyer wants to know.
It's very interesting. I use the analogy that your company is a machine. It's a machine that takes in revenue and throws off profit. And that's great during the time that you own the company. The secret sauce is whether or not that machine is transferable to somebody else. That's where you get your liquidity event. And yes, buyers care a lot about whether or not your machine throws off 3% margins or 15% margins. And that's going to have a major impact on how much they're willing to pay for that machine.
Yep.
We have another company here about ESOP, a question about ESOPs.
Yeah.
Are ESOPs still a popular transition strategy in GovCon? You want to take a first shot at that one, Joe?
I've seen, I don't know, popular. I wouldn't say they're popular. They are there. I knew of a gentleman who he did an ESOP because he loved working. And if you love working and you want to be on for another 10 years and that's what you love, I think it's a good strategy, because you can, or taking a minority investment, but an ESOP in some ways a way to run your company, take some chips off the table, without needing to have minority capital invested in you, promising to grow, right? So I think it's a good strategy for a certain type of owner. I don't know about you, Sharon, but a lot of the ESOPs I saw that were impacted actually had pretty significant USAID contracts. There was a fairly high relationship between these ESOP companies and those who got cut. So I do have some empathy for the structure and the employees who are in the ESOP. And but I don't know if that was anecdotal or you saw that same thing.
I saw some of that.
Okay.
And ESOPs tend to go in and out of favor. And let me start off by saying that ESOPs can be a wonderful, wonderful tool. There are tremendous tax advantages associated with them. Having said that, they're very complicated and they're expensive to run. One of the things about GovCon is that you could be 100% certain that you're going to win your recompete and lose it. And it really requires there being a fairly stable cash flow. And particularly in 2025, stability is not necessarily the watchword. So stocks can be challenging, and I would think there's going to be a little bit of a pullback from the financing sources because it really is going to depend upon the future ability of company to pay back that debt. Another factor, particularly in GovCon, is that if you lose a contract, all those employees might simply be rebadged someplace else. So there are definitely GovCon companies where employees have been there for 15 years and all the rest of that and get to vest into the ESOP. But there are other companies where the employees are there for 2 or 3 years and then may bounce back and forth between different companies. If that's the case, those employees will not benefit from the ESOP because they will not be there long enough to vest. So ESOPs have great attributes. It's complicated in GovCon. It is certainly doable, but there have definitely been cases where it's gone very badly as well. We're getting towards the end. I'm going to try and do one more question. Do you think that IT services contractors are at a higher risk of DOGE cuts, even if they're working on contracts that require security clearances? I really feel like DOGE cuts have not had that level of predictability. There's certainly been a lot in IT, but that's because there's so many IT contracts in federal government contracting. Security clearances are a wonderful thing. I have seen companies that have security clearances get some cuts, but I do think those security clearances provide a little bit of protection that uncleared contracts might not. Joe, what's your thought?
It's a gret question. I'll actually defer to you on that. I haven't gotten that deep on the IT side. I hope not. Quentin sounds. I believe there's probably efficiencies somewhere in the IT space, but I just don't know how much they're going to dive in there. I think security clearances are a big deal. I think having those is a really big differentiator for people, both owners and employees. So I see that as at least having some cushion against cuts.
Joe, I want to thank you for your time here. Really, Jennifer, if you wouldn't mind bringing us home.
Thank you. I'd like to thank you both. I'd like to thank Sharon Heaton and Joe Cope for a great discussion. And to everybody who attended, thank you for joining us. And if you have any additional questions, please don't hesitate to reach out to our panel. Their emails are on the slide. I'll keep it open for a little bit in case you want to take a shot of the slide with your cell phone. We hope you have a wonderful day and hope you found this informative. Thanks.